All right, so picture this. You buy a call, the stock moves your way, you're feeling good, then you check your P&L and you're somehow down. Makes no sense, right? Yeah, that happened to me too. And the reason is something called IV. So today I want to break this down for you because once you get this, a lot of things about options trading are going to start clicking. Let's talk about it. Okay, so IV stands for implied volatility. Sounds fancy, but it's really not. All it's telling you is how much the market expects a stock to move. Not up, not down, just how big of a move people are expecting. Easiest way I can explain it, think about buying a flight. You ever notice flights get way more expensive around holidays? Same seats, same plane, but the demand and the uncertainty jack up the price. That's exactly what happens with options. When people expect a big move in a stock, the demand for options goes up. So the price goes up, that extra cost, that's IV. Okay? So here's where people get wrecked and nobody warns them about this. Let's say a company's got earnings tomorrow. Everyone's nervous. Nobody knows what the numbers are going to be. So there's a ton of uncertainty. And all that uncertainty is pumping up IV, which is making options super expensive. So you jump in, you buy a call, earnings come out, stock pops 3%. You're thinking, let's go, I nailed it. Then you open your broker app and you're red. Like what? What happened is as soon as earnings dropped, the mystery was over. Everyone got their answer. So IV just falls off a cliff. And when that happens, your option loses a chunk of its value overnight, even though the stock went your way. That's called IV crush. And honestly, this is probably the number one thing that catches new options traders off guard. All right, so now you're probably thinking, okay, so how do I stop getting crushed by this every time? First thing, just be aware of when IV is high before you buy. Most brokers have something called IV rank. It's a number from 0 to 100 that tells you where IV is compared to the last year. If it's above 50, that means options are getting pricey. If it's up near 80 or 90, you're paying a huge premium just for the hype. Glance at that number before you enter. Takes a few seconds. Second thing, if IV is high and you still want to get in, you need the stock to make a big enough move to cover that inflated premium, like a really big move. So ask yourself, is this stock realistically going to move 5, 6, 7%? If the answer is probably not, that trade isn't worth it no matter how confident you feel. Third thing, timing matters. If you're buying options before a big event like earnings or a Fed meeting, just know you're buying at peak uncertainty. Sometimes the smarter play is to wait, let the event pass, let IV come down, and then enter when options are cheaper and you can actually get a clean move without all that extra noise working against you. Let me just paint it for you real quick. Stocks at $100. Earnings are tomorrow. IV is sky high. You buy a call for $5. Stock goes up 4%. Solid move, right? But IV tanks right after earnings. Your $5 call is now worth like $3.50. You read the chart right, you got the direction right, and you still lost money. All because you bought when IV was inflated and didn't account for the drop. Now imagine you waited. Earnings pass, IV settles down, the stock is still trending up. You buy your call now at a way cheaper price, and you ride the continuation move without IV working against you. Same stock, same direction, just better timing. Look, IV is not some complicated Wall Street thing. It's literally just the price of uncertainty. And once you start paying attention to it before you buy, you're going to save yourself from a lot of trades where you are right but still lost. All right, that's all I got. I'll catch you in the next one.